Climate change is a recognized threat to the global financial system. It poses risks to nearly every company in virtually every industry, to varying degrees, of course. If identifying and addressing climate risks is not already a core part of a firm's enterprise risk management plan, it should be moving forward. Broadly speaking, climate risks and their subsequent management can be broken into one of several categories. Historically, these were physical risks and transition risks. Physical risks are things like fire and flooding, actual physical impacts to a company infrastructure, customers, or supply chain partners that result from climate change. Transition risks are much broader and arguably more difficult to quantify. Transition risks include economic, social, regulatory, or even geopolitical risks that emerge from the transition we're seeing into a more sustainable business landscape, both domestically and abroad. Most ESG rating agencies, like Sustainalytics, CDP, Moody's, among others, as well as disclosure and assessment frameworks, like the Sustainable Accounting Standards Board or the United Nations Principles of Responsible Investment, bucket into these two categories. However, a rapidly emerging third category is gaining traction, and it's particularly relevant to finance and banking professionals. This is the concept of liability risks. Liability risks manifest in the form of a very difficult to answer question. Who is going to be financially responsible or liable for any costs associated with the aforementioned physical or transition risks, if or when they occur? Let's look at each in turn. As noted in our opening chapter, climate change affects our physical environment. Perhaps most notably, evidence suggests that it's increasing the instance of extreme weather events like flooding and fires, which can impact physical assets, infrastructure, and the availability or accessibility of agricultural inputs and natural resources. Physical risks of climate change can be broken down further into acute and chronic risks. They can also be thought of as being impactful to either the business itself or its financial position specifically. Acute risks refer to those that are present and damaging in real time, like extreme storms, heat waves, drought, and so on. An easy example is damage to an organization's physical plant and property from, let's say, flooding. This damage creates very acute consequences that are immediately apparent. Disruptions to operations are, obviously, an example of a business impact. But that same flood could also have separate and specific financial consequences. What if, for example, the property and equipment that got damaged had been serving as collateral against corporate credit exposure? Or maybe millions of dollars in inventory was destroyed, much of which was backstopping the company's operating credit. Management may be required to restructure its credit exposure at a time when A, it has very little bandwidth to do so, and B, frankly, when the company can least afford to have its access to liquidity restricted in a way. Chronic physical risks may be less obvious as they occur over long periods of time, but they risk compounding in severity over that course. Think of gradual rises in temperatures and sea levels, or the slow degradation of ecosystems and the resulting loss of biodiversity. Though these impacts may not be felt or noticed every day, they can be deceptively destructive over time. Consider that receding coastlines and rising sea levels present the risk of some future tipping point where entire coastal communities, even very large metros, may become unlivable. Or maybe large regions of agricultural land become unusable because of drought and desertification. Hopefully, these never materialize. But if they ever did, the mass migration and disruptions to food security could be absolutely catastrophic. As a concerned citizen, or as a business or finance professional today, there are 3 key themes to be aware of. They are as follows. Impacts are local, but the implications are global. This means that, although a given organization may not directly experience physical damage at company sites, impacts to other parties along the value chain can, and have already been shown to, create global ripple effects. For example, if a key supplier's facility suffers acute damage from climate change, that disruption will become your disruption or that of your clients, perhaps. The global supply chain snarls that emerged during COVID and after COVID lockdowns demonstrated just how tightly connected operators are across the globe. Chronic climate issues risk magnifying this by removing important links in the supply chain in an unpredictable fashion. Physical risks compound over time, and the most vulnerable bear the brunt of their wrath. Historic, systemic inequalities regarding housing, investment in infrastructure, and the allocation of financial resources for particular communities have become increasingly susceptible to the physical impacts of climate change and natural disasters. The welfare and livelihoods of low-income, communities of color, and other vulnerable population groups tend to be disproportionately affected by both acute and particularly chronic physical climate risks. And finally, we're not moving fast enough. We should note that much progress has been made in some jurisdictions and at various levels across the regulatory environment, and that's commendable. But society's collective effort towards proactively battling climate change is not moving quickly enough to avoid potentially catastrophic water and food security issues, and the inevitable climate migration that will follow in many parts of the world. Most business enthusiasts tend to believe that innovation is best served up by entrepreneurs. So it's incumbent upon the business community to lead the way. More specifically, the capital markets have the capacity to be major agents of change by collectively allocating or restricting capital according to ESG or other related mandates. This assumes that market participants can be equipped with the right tools and incentives to actually exert that influence. Transition risks are much broader than physical climate risks, as they refer to a wide range of potential systemic impacts that may arise from the transition to a net zero economy. These include a range of economic, social, environmental, technological, and geopolitical risks. Companies are facing, and will continue to face, increasing transition risks as physical changes play out, and instances of acute climate events become more frequent, more obvious, and more destructive. Sometimes management teams will be faced with multiple transition considerations simultaneously, making a company's net zero transition work critical to mitigating this collection of unique risks. Let's look at an example of how interdependent transition risks can be in order to help illustrate. Consider that as societies transition towards a more sustainable economy, including net zero commitments, fossil fuels may continue to fall further out of favor. We're already seeing many markets where it's become harder for energy companies to secure funding. So management is faced with the reality that the cost of capital is going up and will likely go higher still. In fact, its very availability is in question in some jurisdictions. What do these management teams do about their workers? And what do politicians in those communities do about the prospect of massive layoffs and widespread unemployment? What happens if regulators continue to tighten their grip on oil and gas? Operators could be looking at unusable assets and an altogether stranded industry. These types of changes in the regulatory environment can materially impact the financial system, and changes in the financial system can seriously influence the regulatory environment, both of which can impact public perception and stakeholder expectations, which then affects business models and so on. This in and of itself isn't new, but tackling it through the lens of climate change is, if for no reason other than it's happening so quickly. If government actors and private operators can't effectively collaborate to support the transition to a more sustainable economy, the fallout could be extraordinarily challenging. In a nutshell, that is transition risk. Although disclosure standards, ESG raters, and other third-party ranking schemes typically categorize climate risks as either physical or transition, liability risk is very real, especially for financial services firms, most notably, perhaps, the insurance industry. Liability risk is exactly as it sounds. Who is actually liable for costs arising from the destruction of assets, the stranding of industries, the mass layoffs that may ensue, or other crippling impacts of a fast-changing regulatory landscape? For example, if a manufacturing facility is shut down due to extreme storms and flooding, who pays for those productivity losses? And who pays for the damage to the actual physical facilities? The insurance industry has become much more selective about where and to whom they are willing to offer business interruption or other policies that help operators defer the financial burden of plant shutdowns and physical destruction. These questions will become increasingly critical as more financial institutions start to incorporate ESG performance criteria into their credit analysis, loan structures, investment criteria, and insurance products. Liability risks broadly refer to situations in which some party must be responsible for something, like an asset and anything that happens to it, or someone, like a partner, in any of their actions. A big one is negligence around fiduciary duty. This includes downplaying or omitting the climate risk exposure of a given asset or investment. For example, an asset management firm may have a liability risk if they knowingly invested client funds somewhere that climate risk exposure existed without appropriately disclosing or accounting for it. If these investments were impacted by physical damage or new regulations, the fund may be held responsible for their negligence around understanding its climate risk exposure. Lenders, like commercial banks and credit unions, are also trying to model recovery rates in loss given default scenarios where formerly good, strong, tangible assets may be worth literally nothing, like oil and gas infrastructure. How does this potentially affect the amount of capital they must hold against credit exposure, and therefore the probability of large segments of their own loan portfolios? Stranded assets can be a major issue. Consider that landowners in oil-producing regions across North America were left with wells that were not economically viable, scattered around their properties after the oil price shock of 2014, when the firms that owned the infrastructure went bankrupt. Similarly, municipalities and state governments ended up with tens or even hundreds of millions of dollars in unpaid taxes from these same bankrupt businesses. Some firms, landowners, and governments are worried that history may repeat itself and are therefore experimenting with bid and performance guarantees, as well as insurance products to help mitigate some of this potential liability risk. Think of it like a great party. Everyone's having a blast while it's happening, but nobody wants to be on the hook to clean up after the music stops. In predictable fashion, the same logic applies to financial liabilities resulting from climate change. As a financial analyst, it's important to understand how these various climate risks impact a company's asset value, business model, corporate strategy, market share, and growth plans. Analysts must know the companies in their coverage universe inside and out. They typically do so by leveraging historical annual reports, industry data, and other types of primary research. But climate risks affect different businesses in different ways, so merely having information at hand doesn't equate to understanding a firm's risk profile. For example, a software company is unlikely to have the same acute climate risk exposure as, say, a REIT, which stands for Real Estate Investment Trust and is a business that owns physical properties, or as an oil and gas company. This is what ESG experts refer to as materiality. It's the notion that material risks are unique across industries and business models and must be contextualized for the world of that business. In CFI's ESG Fundamentals course, we unpack what goes into a materiality assessment, but we can cover the main high-level considerations here. The four main areas of focus are industry, business model, corporate growth strategy, and impacts to key stakeholder groups. First, an analyst will want to understand what risks are specific to the industry itself, as illustrated in our software versus REIT example. Next, we look to consider the business model of a specific company, perhaps relative to its peer group, to identify idiosyncratic risks that are unique to a single firm. Here, we look at REITs again. While all REITs own physical properties and are notoriously exposed to acute climate risks as a result, a specific REIT that owns mostly resort-style hotels in South Florida has distinctly different flood risk exposure than a REIT that owns office buildings in the upper Midwest. Management's growth strategy may also inform climate risk exposure and should be evaluated independently from industry and business model considerations. Consider an oil and gas company that wants to expand into nearshore drilling in coastal Louisiana. Again, this strategy would present different exposure to acute climate risks than if management specialized in hydraulic fracturing and had their sights set to onshore expansion in the Permian Basin. Although the fracking component may subject them to unique transition risks, even relative to other energy companies. And finally, understanding potential impacts to key stakeholder groups is also paramount. Most notably, those that are most immediately up or downstream from the business, meaning direct suppliers and customers. A supplier in Central California faces wildfire risks that a supplier in other parts of North America may not. To assume that this doesn't change the upstream climate risk exposure of this buyer is naive, and it paints an incomplete picture from the perspective of enterprise risk management more broadly.